Chapter 13, we're going to start talking about this model of a small open economy and some of its implications. Essentially, what we're talking about when we're talking about a small open economy is an economy that's open, but small enough to not have too much of an impact on world interest rates. So Canada would fit that general idea. So a few things we'll modify, and a few of it has been discussed at the end of chapter 12, such as what we're going to start off with here, which is this idea that in the small open economy, we have that the interest rate in this country is the same as the world interest rate. So the goal of the model in this chapter is to highlight the forces that determine the economy's trade balance and exchange rate, and the focus will be on the two different markets, the market for loanable funds in an open setting, and the market for currency exchange. That's what we're going to focus on. So let's look at the market for loanable funds first. This we've seen before, but just a good reminder. Our savings, our national saving, has to be equal to domestic investment plus money that's leaving. So that's the situation that we have. In a closed economy, the real interest rate is the one that's determined by the supply and demand of loanable funds. So if we have the supply and demand of loanable funds, well, this interest rate here that you obtain, this would be your equilibrium interest rate. However, in an open economy, the real interest rate is equal to the world interest rate. So as mentioned on 2 slides ago, it's this R is equal to RW. This assumes perfect capital mobility and ignores tax differences, treatments, and default risk are ignored. So overall, some simplifying assumptions, but that's the general idea. So what will this look like? Well, it will look something like this. Let's say if we were in a closed economy, this would have been our interest rate, and our interest rate is less than the world interest rate. Well, then naturally we could think that a bunch of our investors would not want to invest at our current rate, but they'll want to invest at a higher rate. So therefore money will be flowing out. So this gap between national saving and investment is this net capital outflow. So at this higher interest rate, so at the low interest rate here, we might have had like $120 billion of loanable funds. Maybe not 120, but rather 130 here. But all of a sudden, because the interest rates are higher, people are willing to save more at that higher interest rate, but not many people are willing to borrow at that higher interest rate. So that's why we can notice that compared to a closed economy, borrowing for investment is going down because the interest rates abroad are higher, making it more costly for them to borrow. But the saving of our consumers and the government, national saving, is greater. And this 50 billion goes to net capital outflow. We've seen before, and this we'll repeat it again, in identities we could always write it with a triple equal sign, but a simple equal sign also works, that there's this identity between net capital outflow and net exports. So when we're going to look for the market for currency exchange, we're really going to take into account this equilibrium between the two, because so far we're kind of analyzing each things individually, saying, oh, if the interest rate is higher, the world interest rate is higher, well, there'll be an increase in net capital outflow. Fine, but an increase in net capital outflow has to also have an impact on an increase on net exports. But in this process, as more money is flowing out, there's something that's going to happen to our currency and so on and so forth. So we're analyzing these individually right now, but in the future, we're going to have to start putting them together. So essentially, we could say that net exports is influenced by this net capital outflow and the world interest rate, but we'll see how the net capital outflow forces and the net exports forces forge the real exchange rate as well, or the actual exchange rate. So we're going to look at the market for currency exchange in this next video.